Good morning or good afternoon. This is your second installment of AgEcon 201 online. So let's start by taking roll. Andrews, Beatty, Bueller. Just kidding, we're not taking roll, but I do want to encourage you guys to watch these. I try to incorporate what we're doing both in the Monday through Thursday or Tuesday through Thursday activity and the Friday quiz. Try to answer some of those questions, give you some insight into the reading, even answer some questions here. You know, something that I had suggested to some of you when we were still meeting face to face was if you're having problems either with class or the reading, to go ahead and email me those concerns, and then I would incorporate those into class. I'm not going to say who it is. I'm just going to say, hey, I had a good question regarding whatever, and your questions will be answered. So that would give you something to look forward to, I guess, if you were looking to see if your question would be answered. So today, we're really only going to go over one topic, and that's calculating ownership expenses. So when we look at the enterprise budget, because remember we're reviewing, we're still not moving forward to whole farm planning, we're just looking at the enterprise budget. The enterprise budget just looks like a pro forma income statement. So you have estimated revenue less operating expenses. So maybe we have $1,000 of revenue per unit, might be per acre or per animal. We have operating expenses of $700. This income above operating expenses of $300. This gives us an idea about short run break even. So as long as we can cover this $700 of operating expenses, it makes sense to operate in the short run whereby something is fixed. And what's fixed are operating expenses. And we all, not operating expenses, back that up, ownership expenses. So my ownership expenses are going to go here, and if we have $300 of ownership expenses, we end up with a net profit of $0. But remember that we're looking at the enterprise budget as if it is an economic budget. And what that means is that all expenses, implicit and explicit, are going to be accounted for. So these operating expenses, you might be paying yourself a fair return already. These ownership expenses are going to include things like, hey, if I wasn't utilizing this land to produce myself, what would a fair rental rate be? So if I have $0 of profit left over, I'm paying myself for my wages up here in ownership or in operating expenses. I'm paying myself for use of my resources, which could include things beyond land. It can include machinery and equipment as well. And I might be giving myself some sort of fair return for management. So this zero in the long run, that's what we expect break-even profit to be, or we expect that's what long-run profit would be. Okay, so within that ownership expense category, we have two kinds of ownership expenses that you might have to calculate, or you might have to think about. You know, I know that the chances of you going back to the farm or ranch this summer and saying, hey, we got to go out and we have to nail down depreciation expense in an economic sense might not happen. But it is something that you can think about, and there are ways that you can come up with depreciation expense rather quickly. You can look at your overall equipment value. We can just look at those assets, value them from a market standpoint. I know a lot of you are on bigiron.com and other web pages like that. Just take 10%. Say, hey, I know this is an implicit cost, but by owning this machinery for the year, 10%. That'd be one quick and easy way. Now, I like to think that your operations will be more sophisticated than that, and your analysis will be more sophisticated than that. So we can come up with a little bit better way to calculate depreciation and the opportunity cost of capital. So we have two ways that we can do that. We can break it down into two pieces, and that's what we're going to do first. Let's say that we have a tractor that has a cost of $200,000 and a salvage value of $20,000 and a useful life of 10 years. Okay? So pause me, take a moment, write that down because I'm going to erase this because of my tiny board. Okay, so we're going to start off with annual depreciation. And we're just going to use straight line depreciation because we know that the amount of depreciation that we have to take over the life of the asset is $180,000. Whether we're using double declining balance or 150% declining balance or modified accelerated cost recovery, we're going to take $180,000 of depreciation over the life. It just matters if we take a lot at the beginning or if we take an even amount as we go on. So we know that we're going to take 180. How we do it could depend. But if I'm looking at this tractor from a standpoint of, I'm going to use the thing kind of the same way for 10 years, and I want to budget and think about what my profitability looks like for the next 10 years, it would be good to come up with one number. What's the ownership expense of using the tractor or owning the tractor for 1 year? So my depreciation is going to be easy. My cost, $200,000, minus my salvage value of $20,000, divided by the useful life of 10 years, gives me annual depreciation of $18,000. Okay, so I'm going to put that up here. So my depreciation is $18,000. Okay, but that's not the only ownership expense that we have associated with the tractor. If you took the $200,000 out of your bank account and it was earning 5%, that means there's $200,000 times 5% of interest that you're not earning this year. And I kind of think about Bizarro World. Bizarro World is this place that's not happening. It's an alternate reality. You can think about, well, I have one world where I put $200,000 in the bank, or it's in the bank, and I just leave it there. It makes 5%. It spits off 10 grand for the year. Or this other bizarro world where I take $200,000, buy a tractor, put it in a shed, lock it, and throw away the key. It's going, at the end of the year, I'm going to have a tractor that's not worth $200,000 anymore. I'm not going to have $5,000 of interest revenue that I would have had before. And I can compare those two worlds to see what it costs to own the asset. And that's what we're trying to calculate here. Okay, so my opportunity cost of capital is related to the value of the asset and the interest rate. And the way that we find the opportunity cost of capital is we just take the asset value, the book value, times the interest rate. So in year one, it's 200,000 times 5%, which is $10,000. I think I said $5,000 before. Excuse me, it's $10,000. In year two, tractor's not worth $200,000 anymore. It's $182,000. 182,000 times 5%. We can do that pretty fast. 18,200 divided by 2 is $9,100. Now I'm running out of marker board pretty fast, and I'm getting a different amount of an opportunity cost of capital every year. And you might say, well, the $200,000 should be what I should calculate every year, but not really, because every year the asset's value is different. You can think about how much money do I have sunk in the tractor each year. Well, in year one, I have $200,000 sunk in the tractor. And hopefully using the tractor increases profitability by more than this $18,000 of depreciation, and hopefully by more than this $10,000 of interest expense, or of interest that's foregone, or interest expense that we're paying. In year two, it's not a $200,000 tractor anymore. It's a $182,000 tractor. And you can think about this weird way that we talked about trying to find depreciation by selling equipment and then rebuying it back. If I bought the equipment back when it was 1 year old, certainly I'm not going to pay $200,000 for it. So what I could do is I could find the opportunity cost of capital for each year of the 10 years and find the average amount. Or I could say, take the average value times the interest rate, and that gives me the average opportunity cost of capital, which is going to be 1/10 of what our opportunity cost of capital would be over the life of the asset. Kind of as a reminder, I'm pitching this like we paid $200,000 for the asset. Works the same way if we said, hey, I have a 5% loan for 10 years and I borrowed $180,000. Same idea. Whether it's money that's explicitly coming out of your pocket or if it's interest revenue that is foregone, 5% is 5%. Okay? How we find the average value is by taking the cost, $200,000, plus the salvage value, and we divide by 2, and then we multiply by 5%. So we're going to do this quickly, add it up here, and then I'm going to explain why we're adding and not subtracting. So 220,000 divided by 2 is $110,000 times 5%. 11,000 divided by 2 is $5,500. So my average opportunity cost of capital, or my average interest expense, is $5,500, which means that my ownership expenses are $23,500, not including licensing and insurance, which goes along with this as well. Okay, the average value. If I said find the average value, you might be tempted to take $200,000 and subtract the $20,000. But if you've had me in 141, and you've probably heard me say this in 201 as well, don't just plug numbers. You've seen that before when you're finding depreciation, and for good reason. When we take the cost minus the salvage value, we're finding out what the total amount of depreciation that we can take over the life of the asset. And then we're dividing that up somehow. We're saying, how are we going to take this $180,000 each year? In this case, we're trying to find what's the average value of the asset. Well, if the highest the value can be is $200,000, because that's the value when you bought it, and the lowest it can be is $20,000, what's the average between the two? And the way that you would find the average is just add them up and divide. Another way to think about it, just because I haven't drawn anything stupid for a while, if you don't know what this is yet, well, here, I'll help you out. Now you have to know what it is. 25 cents. It's a gumball machine. Once in a while, you'll see a big gumball machine. It'll have some deal where you can guess how many gumballs there were, and you can win the gumball machine or something like that. Okay? Let's say that you know that the gumball machine, when it's full to the brim, has 1,000 gumballs. And when it gets down to this level where you can't see any gumballs any longer, there's 100 gumballs. This gumball machine is an electronic gumball machine. It has Wi-Fi. When it gets down to 100 gumballs, a signal goes out to whoever fills it, and they fill it up to 1,000 gumballs. This sounds really silly, but this is actually how some pop machines work. That's how the bottlers know to come refill them. So if you knew that when it's full, it has 1,000 gumballs in it, and it never falls below 100, and you can't see it, and someone said, what's your best guess of how many gumballs are in the gumball machine? The best guess would be 550. It never goes below 100. So taking 1,000 minus 100 doesn't make any sense. The average amount is 550. And we know that because if we calculated how many gumballs there were from the beginning when it's full, 1,000, to the end when it has 100, and added up all those numbers and divided by the days, the average would be 550 on the nose. That's one way to think about why we're adding the salvage value instead of subtracting the salvage value. Okay? So there we are, $23,500 would be a good estimate of what our ownership expenses would be for this tractor. However, it can be more precise than that. And as your assets get bigger and bigger and bigger, it becomes probably worthwhile to come up with a more sophisticated way of calculating what our actual ownership expenses are. So one way that we can do that is by using the capital recovery method. And our annual capital recovery expense each year is equal to my total depreciation times an amortization factor plus the interest rate times the salvage value. And this is in your textbook in the enterprise budgeting chapter near the end. You can look it up. The reason why this is more specific is about compound interest. If you think about the interest expense that you're foregoing every year, the interest expense of the $180,000 or the $200,000 in year one, 20,000 of that is every year. So there is interest on interest that this number is not calculating. If we take our total depreciation and we plug it into an amortization schedule and we say, okay, now we understand how compound interest works, and we know that we're actually giving up for the last dollar 1 to the 10th, 1.05 to the 10th power, and for the previous $18,000, 1.05 to the 4th power, and for the previous $18,000, 1.04 to the 3rd, we will actually come up with a bigger amount of ownership expense, I think. Okay, so we're going to take that $180,000, we're going to split it up, we're going to understand compound interest, and we're going to do it using this formula. So my total depreciation is $180,000, and my amortization factor, you'll find a book, you can find back here at the end. There it is on page 447 in the red book. Amortization factor for equal total payments. So what this is saying is, if you borrow $180,000 at 5% interest, and that's really what I'm doing, I'm looking at this $180,000 and saying, I'm losing that $180,000 plus interest. I want to split it up, understanding compound interest. I go to 5% in 10 years. I get an amortization factor of 0.1295 plus 0.05 times the salvage value of $20,000, because I have that 5% left over that I have to account for as well. If I do that, I get, this is 23,310 plus $1,000. Using this method, I come up with $24,410, which is $910 more per year, or $9,100 more ownership expense over the life of this tractor at 5%. Now, over a longer life with higher interest rates, my two different methods are going to diverge. They'll become even bigger, because interest on top of interest is a powerful thing that we're actually going to look at quite a bit more going forward. So if this is scaring you off a little bit, I hope it doesn't. So let's review. Number one, if I buy a tractor, lock it in the shed and throw away the key, it's going to depreciate. This is an estimate. $200,000 tractor. I think it's worth $20,000 at minimum. Means I'm going to have $180,000 of depreciation expense. So you can think about why are prepaid expenses assets? Think about a tractor like prepaid depreciation. Buying $180,000 of depreciation expense, and I'm going to take 18 grand per year. Plus, because I've sunk a whole bunch of money in this thing, I've got $5,500 of interest every year. Or I can think about, hey, I've got $180,000 that I'm basically borrowing, and I'm going to incur $24,410 payments each year if I'm including the fact that there's interest expense. So this breaks it down to understand the two. This makes it a little bit more specific. This is where I want your understanding to be. If you're like, hey, I get this, and I understand why this is falling short a little bit, that's awesome. This ought to help you out with your quiz that you've got going on. Remember, you can take it over and over again until you get the full 10 points. Friday's quiz will be during class. That's the only time you can take it. And I'm looking forward to any questions that you might have. Remember that we're meeting on Zoom tomorrow, so we can go over this stuff a little bit more if you like, or answer any other questions, direct me one way or another, or just chat and catch up. All right, I'll see you guys then. I'm looking forward to it.